In this week's video, we'll review a wide range of data sets to help us better understand three major shifts that will significantly impact your investment strategy. The major shifts that we'll be covering occurred between July of 2019 and August of 2020. The first shift relates to demographics. As we've covered in previous videos, when you have a relatively large percentage of your population in these areas here, so relatively young people and relatively old people, and these groups are large relative to people aged 35 to 54, we tend to have secular stagnation or bear markets for financial assets. People on this end of the age spectrum and on this end of the age spectrum tend to consume more than they produce, and peak earning and spending years typically occur between the ages of 35 and 54. As you might imagine, when the script flips and we have a larger percentage of the population in that 35 to 54 window relative to these age groups down here, we tend to get economic booms or secular bull markets in financial assets. And in July of 2019, the millennials overtook the baby boomers as America's largest generation. And relative to their peak earning and spending years, the oldest millennial turned 35 in 2016. This period here was the millennials' birth window, but it also happened to be the period where the baby boomers were in their peak earning and spending years. The oldest boomer turned 35 in 1981. They started to leave their peak earning and spending years in the year 2000. You can see between point A and point B, really good things happened in the stock market. And thus, this shift that began in July of 2019 is very significant from an investment perspective, and it will most likely influence asset allocations for years to come. Shift number 2 relates to fiscal policy. Think government spending. You can read about modern monetary theory on the right side of your screen from U.S. News and World Report. Modern monetary theory argues that nations with the ability to produce their fiat currency can issue as much money as they need, and as a result, they have no pressure when it comes to financing. In other words, the government cannot run out of money, and it essentially has no financial constraints. And it's probably fair to say the vast array of government programs in the United States and around the globe that were announced in the wake of the pandemic, at a minimum, took a page from the modern monetary theory playbook. From a historical perspective, an incredible amount of money was injected into the U.S. and global economies. Shift number 1, July 2019, the millennials overtake the baby boomers. Shift number 2 begins in March of 2020, when the COVID response borrows from the modern monetary theory playbook. And the third leaf of the clover relates to a major shift in monetary policy, think Fed policy, that was announced at the end of August in 2020, where the Fed stated they were willing to tolerate higher rates of inflation. And in terms of their dual mandate, which speaks to price stability and maximum employment, they'd be willing to put price stability on the back burner from time to time and become more focused on maximum employment. Anyone that's been following the Fed for any length of time will tell you that was a significant change. Thus, back in July of 2019, we had a very powerful and favorable demographic shift that began to take place. And you can make an argument that the demographics were turbocharged by the government's response to COVID. And then the Fed added a twin turbo to the mix when they announced that major policy change in August of 2020. And thus, today we have an incredibly powerful and positive driver with newly mounted twin turbos now on board. We've all been reading a lot about supply chain issues around the globe, but as Bridgewater Associates points out, it's not just a supply issue. There's been an incredible increase in demand. The chart in the lower right-hand corner of your screen comes from a Bridgewater report. The blue line here, this is demand. This is diminishing demand during the COVID plunge in the S&P 500. So demand is in blue. Notice demand well above pre-COVID levels. And then in the second half of 2020, demand in blue starts to really take off. And while global production did take a hit, it's also ramped back up and is above pre-COVID levels. If we focus on this portion of the Bridgewater report, they state that what happened in the 1970s was truly a supply shock. Supply collapsed and demand stayed relatively constant. And they note that's significantly different from what we have in the present day. Today, demand is surging and supply is also growing. It just can't keep up with demand. From an economic standpoint, that sentence really doesn't sound too unfavorable. It actually sounds very favorable. Another relatively significant difference from the stagflationary period in the 1970s relative to the present day was covered in the October 22nd CCM video. In sharp contrast to the present day, the unemployment rate in the 70s had been rising for quite some time when you reach 1975. Started to pick up way back in 1969. And like the present day, inflation was also increasing. But to get the stag component, we would need to have something similar to what we experienced between 1969 and 1975 in the U.S. labor market. The unemployment rate in the late 1960s was below 3.5%. By the time we got to the mid-1970s, we were in the 9% region. That is in sharp contrast to calendar year 2020 and calendar year 2021. Back to the Bridgewater report. Middle left side of your screen. This is not, by and large, a pandemic-related supply problem. As we'll show, the supply of almost everything is at all-time highs. Rather, this is mostly an MP3-driven upward demand shock, which was the blue line that we talked about earlier. And when they refer to MP3, they're really just referring to two of the clover leaves that we've already covered. Under MP3, monetary and fiscal policy is used hand in hand. Turbocharger number 1, turbocharger number 2. And when a considerable amount of new money is injected into the economy, it's not hard to find quotes like this. Holders of cash have lost their purchasing power and seen a reduction in the value of their money. And the same process is also happening in bonds. These concepts in this quote on your screen seem to align nicely with this chart that we've covered numerous times in the past. This is stocks versus bonds, and it too is tied into the demographics. Remember back in 2019, the millennials overtook the baby boomers as America's largest generation. The millennials, which have a much longer time horizon, are much more interested in growth vehicles, such as stocks, relative to the baby boomers that have been focusing on more defensive assets in recent years, such as bonds. Thus, the demand for bonds is starting to fall victim to the mortality table, while the millennials are just now starting to enter their peak earning and spending years. And all of that seems to align nicely with the chart of stocks versus bonds that on November 18th, 2021 is above this peak. This peak here is way back in the year 2000. In this period, we're seeing the baby boomers and their demand for bonds pick up. That's in sharp contrast to what we have in the present day. Also in sharp contrast, notice the ratio rolls over here in the year 2000. This is the dot-com bust. Look at this. Financial crisis bust. Look what the ratio does. Look what the ratio has been doing in the rearview mirror. This really doesn't look anything like this. And it really doesn't look anything like this. And while it is true that this blue line here is mostly an MP3-driven upward demand shock, it's also impacted by the shifting demographics. This chart's heavily influenced by demographics and ties in nicely with the secular bull market thesis. It's also interesting to note the NASDAQ relative to the S&P 500 is just now, this chart's November 4th, 2021, trying to exceed the peak that it made back in the year 2000. This is 21 years sideways movement. We can draw a horizontal line from this point here to where we are in the present day, and from this point here all the way back to the peak in the ratio in calendar year 2000. The longer a market goes sideways, the bigger the move we can expect to get if we either get a bullish breakout or a bearish breakdown. What could cause this ratio to break out of a box that it's been in for 21 years? 2 words: transformative technologies. And who is perfectly positioned to assist with the 10 technologies on your screen? The millennials. They've been exposed to technology since birth, and they're just now reaching that sweet 35 to 54 peak earning and spending years window. And we know in all 10 of these areas, we need an educated workforce. Turns out the millennials are the most educated generation in history. If you haven't seen it, you can find more information about demographics by Googling the title on your screen. This was a video that was published on September 24th of this year. So we have this significant demographic shift in July of 2019, a significant shift in 2020 relative to the government's role from a spending perspective, and another easier money shift made by the Fed in August of 2020. Anything else? Yes, Bloomberg article dated October 18, 2021. By some measures, U.S. balance sheets are the strongest in years. Chart from this Bloomberg article on the left side of your screen. Spending on debt is at the lowest since at least the 1980s. Why at least the 1980s? Because we only have records going back to 1980. Similar situation here. Data going back to 1987. Liability to asset ratios have never looked better. And why is all of this important? Because if we're going to have an economic boom, we need to have a consumer spending boom. And typically, access to credit is a big part of an economic boom. These charts, October of 2021. This data, end of Q2 2021. Household debt service payments as a percentage of disposable personal income. You can see since the financial crisis in here, shaded area is the recession during the financial crisis, improving significantly. And if we look on a longer-term time horizon, never been more favorable going back to 1980. And if this line starts to turn back up, that's not necessarily a bad thing. Started to turn back up in 1993. It rose for 14 years into late 2007, early 2008. And if Americans start to leverage their favorable credit situation, like the period from 1993 to the year 2000, this line turns back up, that can lead to a significant increase in consumption and spending on big-ticket items. If we think in the context of this topic and the 3 leaves of the clover, it's not particularly shocking that in 2021, U.S. financial conditions are near the loosest they've been in 4 decades. Also something that aligns very, very nicely with the secular bull market thesis. Another thing to keep in mind relative to the supply chain issues. As noted on Twitter earlier this week, those who label problems as too big to solve often underestimate human beings' ability to adapt, innovate, and change in the face of adversity. This tweet was constructed at 11:15 a.m. on November 16th and was done so with all of this in mind. Just reading article after article about the supply chain issues, all of them, for the most part, negative. Shortly after this tweet, 11:15 a.m. on November 16th, around 3 p.m. on the same day, Carl Quintanilla tweeted, "The number of containers sitting on the docks at the Port of Los Angeles has declined by 29%. And while there are legitimate and significant concerns related to supply chain issues, we also have to keep in mind there's a lot of bright and talented people working on the problems. We don't have to go back very far either to find a problem that was considered to be too big to solve, that via the work of a lot of bright and talented people, hardworking people, despite a lot of the headlines in 2020, we were able to find a vaccine much, much faster than historical timelines. During the pandemic, a lot of younger people became interested in investing, speculating, and they became interested in the stock market, some of them for the first time. And if financial assets are to see something similar to what they saw from 1982 to the year 2000, we need to see things like Staples Center in Los Angeles being renamed to Crypto.com Arena. To summarize, recently we had major shifts in demographics, fiscal policy, and monetary policy. All of those tend to point to a higher inflation environment walking forward. And if we assume that inflation over the next 5 to 10 years will be higher than what we've seen in the prior 5 to 10 years, it also makes sense that the financial markets could see significant allocation shifts away from bonds and cash-oriented investments and into growth-oriented investments such as stocks. We also have a lot of game-changing technologies that have already gained traction, and we have the most educated generation in history moving the ball forward in these 10 areas. And the now largest generation in the United States and the most educated generation in the United States are in a position to leverage those healthy balance sheets to buy big-ticket items such as cars and houses. When we see a video like this and we read a headline like the one in the upper left-hand corner of your screen, it's very, very easy to become myopic in a bullish manner. Thus, it's incredibly important to have realistic expectations about how markets operate in the real world. All trends, even the strongest secular trends, have counter-trend moves. As long as the clover leaves on your screen align with the charts in front of us and align with the base case, we can maintain a secular trend allocation. But if the charts in front of us start to change in a meaningful way, it's important that we remain open to a wide range of outcomes, from wildly bullish to wildly bearish. And we all know the only way that we can do that effectively is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.